The $8,400 tax mistake millions of retirees make every single year. Frank is 68 years old. He retired from the city water department after 31 years on the job. He lives with his wife in a small ranch house outside Albany, New York. Their gross income sits around $58,000 a year. A modest pension, Social Security, a small private annuity, and a brokerage account they have been holding since the kids were in college. Every February, Frank drives to the same strip mall tax preparer he has used since 2012, hands over a manila folder of paperwork, and walks out 45 minutes later with a return that says he owes the federal and state government around $2,700 combined. He has no idea he should be paying close to nothing. 5 separate tax savings exist right now in the law that apply directly to his exact situation.
His preparer has never mentioned a single one. Not because the preparer is dishonest, but because the preparer is doing exactly what most chain tax shops are paid to do. Get the return done in under an hour, file it, and move on to the next person. The deductions, credits, and exemptions I'm about to walk you through live in places a 40-minute appointment will never reach. They hide in state tax software dropdowns that get clicked wrong. They live in county assessor offices completely separate from the IRS. They sit inside federal tax brackets that require active multi-year planning, not passive April filing. This year alone, the number for Frank is $8,400 left on the table, and most of it repeats every single year going forward. If you are retired, own a home, draw a pension, or hold investments outside of an IRA, what you're about to read could permanently change how much money stays in your pocket versus how much gets handed over to federal, state, and local governments. This information is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. Let's get into the 5 overlooked retiree tax savings that most tax preparers completely miss. The hidden reality of retiree tax overpayments. Before we break down each strategy, you need to understand why this happens so frequently. The tax code is not designed to automatically give you every break you qualify for. It is designed to collect revenue unless you actively claim what the law allows. Most retirees assume their tax preparer is scanning every possible deduction, credit, and exemption. But volume-based tax preparation operates on speed, not strategy. When a preparer is paid per return and expected to process dozens of clients daily, they rely on software defaults. They enter your 1099s, they apply the standard deduction, they hit calculate, and they print. They do not cross-reference county property tax records. They do not review state-specific retirement income exclusions that require manual override. They do not model multi-year capital gains harvesting against Medicare IRMAA thresholds. They do not know about refundable state circuit breaker programs that live on completely separate forms. The result is systematic overpayment, not because of fraud, because of structural blindness. A recent foundation report revealed that 9.3 million older adults are currently eligible for property tax relief programs in their own state. Only 8% of them apply. The other 92% are paying property taxes that the law explicitly says they do not owe. That is the landscape we are operating in. And it is exactly why you need to understand these 5 strategies yourself. Strategy 1. The Senior Property Tax Exemption and Assessment Freeze. This is the single biggest miss for retirees who own their home. Almost every state offers some version of a property tax break for homeowners, age 65 or older. In some jurisdictions, it reduces the assessed value of your home for tax purposes. In others, it freezes the assessment so your taxes cannot climb year after year as your home appreciates. In many places, it does both. Texas gives every homeowner age 65 or older an additional $60,000 exemption from school district taxes, then freezes the school tax bill at the level it was when you turned 65. New York offers the senior citizens exemption, which can reduce the assessed value of your home by as much as 50% if your income meets local limits. Illinois has a senior freeze that locks your equalized assessed value if your household income is below $75,000 statewide. Florida provides low-income seniors an additional $50,000 homestead exemption on top of the standard homestead benefit. The savings range from a few $100s annually in modest tax jurisdictions to several $1,000s in high-tax states. And here is the critical detail. None of them are automatic. Every single one requires you to file an application with your county assessor or local tax office. They will keep collecting full taxes from you year after year until you walk in, mail the form, or apply online. The county does not cross-check your age with the IRS. The system does not notify you. The burden is entirely on you. Frank has been paying full property taxes for 3 years even though he qualifies for the New York Senior Citizens Exemption. The exemption is filed with his county assessor, not on his federal or state income tax return. They are completely separate systems operating on completely different deadlines. The estimated savings for Frank if he applies is approximately $1,800 a year every year for as long as he lives in the house. That is $18,000 over a decade, $27,000 over 15 years, all from a single form that takes 20 minutes to complete. If you own your home and are 65 or older, this is your first immediate action item. The money is sitting in your county's budget, waiting for you to claim it. Strategy 2. Free professional tax preparation through IRS and AARP programs. The IRS funds 2 free tax preparation programs every single year. They are called Volunteer Income Tax Assistance, VITA, and Tax Counseling for the Elderly, TCE. The TCE program is specifically designed for taxpayers age 60 or older. Most TCE sites are operated by the AARP Foundation through a program called Tax-Aide. AARP Tax-Aide alone runs over 3,600 locations across all 50 states from early February through April 15th. The volunteers are IRS certified every single year and trained specifically on retirement tax issues, pensions, Social Security taxation, required minimum distributions, and recent legislative changes affecting senior taxpayers. AARP membership is not required. The service is completely free. Last filing season, the program helped over 1.7 million people recover $1.3 billion in refunds and credits they would have otherwise missed. Now, here's what you need to understand up front. AARP Tax-Aide volunteers prepare your current year tax return accurately. They are not financial planners, and they are not permitted to give forward-looking investment advice or multi-year tax strategy. If your situation is straightforward, Social Security, pension, simple investment income, standard deductions, they will catch every credit and exclusion you qualify for, including state pension exclusions that cheap preparers routinely miss. If your situation requires multi-year planning, like timing Roth conversions, harvesting capital gains strategically, or modeling IRMAA exposure, that is a separate conversation with a fee-only fiduciary CPA or certified financial planner. But for the simple act of preparing your annual return correctly and catching overlooked deductions, Tax-Aide is arguably the best free service available to retirees in America. Frank pays his strip mall preparer about $400 every year for a return that consistently gets the New York pension exclusion wrong. Switching to a certified TCE site eliminates that $400 cost entirely and dramatically increases the accuracy of his state return. To find a TCE site near you, visit the IRS website or call the AARP toll-free number at 888-227-7669. The estimated annual savings just on preparation costs is around $400. The bigger savings comes from the deductions a properly trained volunteer will catch that a rushed commercial preparer will skip. Strategy 3. The State Retirement Income Exclusion. This is the deduction that varies the most by state and is the one most retirees know the least about. 13 states in America do not tax retirement income at all. 9 of them have no state income tax to begin with. Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. 4 more, Illinois, Iowa, Mississippi, and Pennsylvania, have a state income tax but exempt all retirement income from it. Pensions, Social Security, 401k distributions, IRA withdrawals. The entire stack is excluded. If you live in any of those states, you have nothing to do for this strategy. But most retirees do not. They live in states with partial exclusions that require manual entry on state tax forms. Georgia allows a retirement income exclusion of up to $130,000 per person for taxpayers 65 and older. Michigan completed its phase-in and now allows up to $67,610 per single filer, or $135,220 for married couples filing jointly. New York exempts all government pension income, federal, state, local, and military, with no dollar limit, plus another $20,000 exclusion on private pensions and IRA distributions for taxpayers 59(1) to 2 or older. The problem is that these exclusions live on the state tax return as a separate schedule or subtraction modification. A preparer rushing through federal to state data transfer will often let the software pull the 1099-R amount directly into state taxable income without applying the exclusion. The software does not automatically know your pension qualifies. You have to tell it, or your preparer has to know to look. Frank has a city water department pension. Under New York law, that pension is 100% exempt from state income tax because it is a government pension. He has been paying approximately $3,000 a year in New York state tax that he does not legally owe. His preparer entered his pension as taxable income on his state return because that is what the federal 1099-R reported. They never navigated to the New York subtraction modifications page on Form IT-201 and zeroed it out. The estimated annual savings, if Frank corrects, this is approximately $3,000 per year. But it gets better. He can amend his last 3 years of state returns and recover roughly $9,000 he already overpaid. The IRS and state revenue departments generally allow amended returns within 3 years of the original filing date. That is a one-time cash recovery that most retirees never pursue because they assume the original return was correct. If you live in a state that taxes income, pull your most recent state return. Look for the line that says retirement income subtraction, pension exclusion, or senior deduction. If you do not see it and your state offers one, you are likely overpaying. Search your State Department of Revenue website for retirement income exclusion rules. The dollars hiding there are often the largest single state tax savings available to retirees. Strategy 4. The 0% long-term capital gains bracket. This one sits in the federal tax code, completely visible, and almost no retiree knows it exists. Long-term capital gains are taxed at one of 3 rates: 0%, 15%, or 20%, depending on your taxable income. Most people assume capital gains are always taxed. They are not. There is a legitimate 0% federal tax bracket for long-term capital gains. For 2026, single filers with taxable income up to $49,450 pay 0% on long-term capital gains. Married couples filing jointly with taxable income up to $98,900 pay 0%. Remember, taxable income is your gross income minus your deductions. For a married couple both age 65 and older in 2026, the regular standard deduction of $32,200 plus the additional senior standard deduction of $3,300 plus the temporary senior bonus deduction of $12,000 gives you $47,500 in deductions before a single dollar of taxable income exists. That means a couple with around $146,000 of gross income could potentially realize long-term capital gains and pay 0 federal tax on them. Now, before you call your broker tomorrow, you need to hear 3 critical warnings. This is where most financial content stops and where retirees get burned. Warning 1. The 0% rate is federal only. Most states tax capital gains as ordinary income. New York taxes long-term gains at rates up to 10.9%. New Jersey up to 10.75%. California up to 13.3%. Only a handful of states mirror the federal 0% treatment. Before you sell, find out exactly what your state does. Warning 2. Capital gains increase your modified adjusted gross income, MAGI. That number determines your Medicare premiums 2 years later through IRMAA, Income-Related Monthly Adjustment Amount. A large gain in 2026 can raise your Medicare Part B and Part D premiums in 2028 by hundreds of dollars per month. The 2-year look-back means decisions you make today echo into your healthcare costs later. Warning. 3. Capital gains add to your provisional income for Social Security taxation purposes. Realizing a gain can push more of your Social Security benefit into the taxable category, sometimes turning a tax-free retirement check into a partially taxable one. The interaction between capital gains, MIGI, provisional income, and IRMAA is why multi-year modeling matters. None of this means you should never harvest gains. It means you should run the full state, federal, Medicare, and Social Security calculation before you sell. This is exactly the kind of strategic decision that requires a fee-only fiduciary planner or CPA who looks at your entire financial picture, not just your current year tax return. Frank and his wife have a brokerage account from the 1980s with about $30,000 in unrealized gains. If they harvest those gains over 2 years while staying in the federal 0% bracket, they save approximately $2,200 in federal capital gains tax. They will still owe New York state tax of around $1,400 combined over the 2 years. Net savings, roughly $800, worth doing, but only after they run the full picture with a qualified planner who accounts for IRMAA exposure and Social Security taxability. Strategic capital gains harvesting is not about avoiding taxes forever. It is about paying them at 0% today instead of 15% or 20% later, while carefully managing the downstream effects on Medicare and Social Security. Strategy 5. The state property tax circuit breaker and rent rebate. This is the most overlooked refund in the entire United States retiree tax system. A circuit breaker is a state program that gives a refund or credit when your property tax or rent is too high relative to your income. Most circuit breakers are refundable, which means even if you owe 0 state income tax, you still receive a check. The program is designed specifically to protect fixed-income seniors and disabled residents from being priced out of their homes by rising property taxes. Pennsylvania operates the property tax and rent rebate program. The maximum rebate is $1,000, and the income limit was permanently raised to $4,810 for both homeowners and renters. New Jersey has the senior freeze, which reimburses eligible homeowners for property tax increases above their base year. The newer Stay NJ program can pay qualifying seniors up to $6,500 combined annually. Vermont, Wisconsin, Minnesota, Maine, and several other states all have versions of circuit breakers tied to age, income, and property tax burden. The catch is that they live on a separate state form. They are never included on your federal return. They are filed independently with the State Department of Revenue or Taxation. If you do not file the form, you do not get the refund. There is no automatic mechanism, no cross-referencing, no notification. Frank does not qualify for New York's circuit breaker because his income sits slightly above the state threshold. But if he were a Pennsylvania resident with the exact same income profile, he would qualify for the full $1,000 rebate every single year. That is $10,000 over a decade. Completely tax-free, completely refundable, completely missed by retirees who assume their tax preparer handles everything. Search your state's Department of Revenue website for property tax circuit breaker, senior rent rebate, or homestead credit. The deadlines are often different from the April 15th tax filing deadline. Some states require separate applications. Some require proof of property tax paid or rent receipts. The paperwork is minimal. The payoff is direct cash deposited into your account. The real cost of inaction. Frank's complete breakdown. Let's bring it all together so you can see exactly how these 5 strategies compound. Frank, 68 years old, pension, Social Security, brokerage account, has been doing his taxes the same way for 14 years. Here's what was missing. Senior property tax exemption, approximately $1,800 per year. Free tax preparation through AARP. Tax-Aide, approximately $400 in annual preparation cost savings. New York government pension state tax exemption. approximately $3,000 per year. State pension exclusion on the private annuity that the preparer also missed, around $1,000 per year. One-time recovery from amending 3 years of incorrect New York returns, roughly $9,000. Added up, and Frank is looking at recurring annual savings of about $6,200 going forward, plus the federal capital gains harvest in the years he strategically uses it, plus the $9,000 amendment refund. The total cash he gets back in his first year of doing it correctly is over $8,400, and most of it repeats every single year. None of this required Frank to be wealthy. It required two things: knowing where the money was hiding and being willing to spend a small amount on a one-time conversation with a qualified planner for the parts that require active multi-year strategy. The gap between the retiree who keeps their money and the one who hands it over to the IRS, the state, and the county every April is not income level. It is whether someone took the time to walk through every tax authority that has a claim on you and check whether you are taking the breaks that already exist for you in the law. Your 5-step action checklist. Before next tax season. Here is exactly what you need to do this month to lock in these savings before the next tax year begins. Step 1. Call your county assessor's office. Ask 3 specific questions. Do you offer a senior homestead exemption or assessment freeze for homeowners 65 or older? What is the income limit and what is the application deadline for the next tax year? Can you email or mail me the application form? Most counties have it available online. Complete it, attach proof of age and income, and submit it before the deadline. This single step saves more retirees more money than any federal deduction. Step 2. Locate a certified TCE or AARP Tax-Aide site. Visit the IRS website or call 8888-227-7669 to find the closest tax counseling for the elderly location. Book an appointment for the next filing season. If you currently pay a commercial preparer $300 to $600 annually, this is the easiest hundreds of dollars you will ever save while simultaneously improving the accuracy of your state return. Step 3. Audit your most recent state tax return. Pull out your last state return. Look for the line that says retirement income subtraction, pension exclusion, or senior deduction. If your state taxes retirement income and you do not see a subtraction for your pension, IRA, or annuity, your preparer likely missed your state's exclusion. Search your State Department of Revenue website for the exact rules, income limits, and form instructions. If you find an error, file an amended return for the past 3 years. The recovery window is limited, but the payoff is immediate. Step 4. Review your taxable brokerage account for unrealized gains. If you hold investments outside of an IRA or 401k, log into your brokerage and check your unrealized long-term gains. If your projected taxable income for the year is below approximately $49,450 for single filers or $98,900 for married couples filing jointly, you may be eligible for 0% federal tax on those gains. Before you sell, schedule a one-time session with a fee-only fiduciary planner or CPA. Have them model the state tax impact, IRMAA exposure, and Social Security provisional income effect. Strategic harvesting works only when you account for the downstream consequences. Step 5. Search for your state's property tax circuit breaker program. Type your state name plus property tax circuit breaker plus senior rebate into your search engine. If your state offers one, the form will live on the State Department of Revenue or Taxation website. Check the income limits, age requirements, and filing deadlines. Many circuit breakers operate on calendar year or mid-year deadlines that have nothing to do with April 15th. File the form annually. The refund is direct, tax-free, and repeatable. The bottom line: structure beats income. Every time Frank started over with everything outlined above, he filed for the New York Senior Citizens Exemption with his county assessor. He booked a Tax-Aide appointment for next filing season. For the multi-year capital gains decision, he hired a fee-only fiduciary planner for a single strategy session that more than paid for itself. He amended his last 3 state returns and recovered around $9,000 in overpaid New York state tax. From a man who thought he was already paying a professional to handle all of this for him, the realization was stark. The system does not protect you. You protect yourself by understanding where the breaks live and claiming them deliberately. Retiree tax planning is not about finding loopholes. It is about using the provisions that lawmakers explicitly built for seniors, fixed-income households, and long-term homeowners. The exemptions exist. The exclusions are written into state code. The 0% capital gains bracket is federal law. The circuit breakers are funded and waiting. The only variable is whether you know they exist and whether you take the steps to claim them. If this breakdown helped you identify money you did not know you were leaving on the table, share it with someone who needs to see it. Drop a comment below. Which of these 5 strategies did you already know about, and which one are you going to act on first? The most common situations help shape future content that protects retirees from systemic overpayment and hidden tax traps. Your retirement income is fixed. Your tax burden does not have to be. The difference between paying what you owe and paying what you could have avoided comes down to awareness, structure, and action. Start with one step this week. The compounding effect over the next 10 years will surprise you.